Can I withdraw my money from Betterment? That is the question on your mind, isn't it? You've spent decades working hard, sacrificing, saving every extra penny, and putting it into a platform like Betterment. And now, you are either retired or you are looking retirement right in the face. This is the moment where the game changes. You are transitioning from the accumulation phase, where you just put money in, to the distribution phase, where you actually need to live off of it. And naturally, a deep, underlying fear starts to creep in. You start wondering, is my money locked up? If I ask for my money tomorrow, am I going to get slapped with massive penalties, hidden transaction fees, or a surprise tax bill that wipes out my hard-earned gains? I get it. When it's your life savings, you want control. You want to know that if you need $5,000 for a new roof, or $2,000 for a medical bill, or just your monthly income to pay for groceries, you can get to it without a fight. Let's answer the big question directly, once and for all. Yes, you absolutely can withdraw your money from Betterment. Betterment does not lock you out of your accounts, and they do not charge you a penalty or a transaction fee just to take your own money out and send it to your checking account. If you want to close your account entirely or just take a partial distribution, they will not charge you a traditional exit fee for a standard withdrawal. But wait! Do not change the channel just yet, because while Betterment won't penalize you, the type of account you hold inside Betterment and the way you withdraw that money can trigger massive, irreversible financial mistakes if you aren't careful. This is where people get hurt, and this is what we need to prevent today. You see, the real issue isn't whether Betterment allows withdrawals. The real issue is what you are withdrawing from. Betterment is a robo-advisor. It holds different types of accounts, and each one has completely different rules set by the IRS, not by Betterment. If your money is sitting in a standard taxable brokerage account, what Betterment often calls a general investing goal, you can request a withdrawal whenever you want. Betterment will sell off the exchange-traded funds, or ETFs, in your portfolio to generate the cash. There is no IRS penalty for this. However, the moment those investments are sold, you have triggered a taxable event. If the investments grew over the years, you now owe capital gains tax. Betterment does have a built-in tool called a tax impact preview that shows you a rough estimate of the tax bite before you click confirm, and their system tries to sell shares with losses first to offset gains. But make no mistake, you still have to answer to Uncle Sam at the end of the year. Now, let's talk about the account type that causes the most fear and confusion for people entering retirement, IRAs. If your money is in a traditional IRA or a Roth IRA at Betterment, the IRS rules rule the day. If you are under the age of 59 and a half and you try to pull money out of a traditional IRA to your bank account, you aren't just paying regular income tax on that money. You are also handing over a devastating 10% early withdrawal penalty to the government. If you are over 59 and a half, that 10% penalty vanishes. You can take out whatever you want. But remember, with a traditional IRA, every single dollar you pull out is taxed as ordinary income. If you pull out too much at once, you could accidentally push yourself into a higher tax bracket or trigger higher premiums for your Medicare. And what if you have a Roth IRA? The beauty of a Roth is that you already paid tax on the money before it went in. You can always withdraw your original contributions at any age, tax and penalty-free. But if you touch the earnings, the growth, before you are 59 and a half and before the account has been open for at least 5 years, you will get hit with taxes and penalties on that growth. There is another scenario where people get tripped up. What if you decide you don't just want a few $1,000s, but you want to move your entire portfolio away from Betterment to a different company, like Fidelity, Vanguard, or Charles Schwab? If you do a standard cash withdrawal to your bank account, you might trigger all those taxes we just talked about. To avoid that, you would do what's called an attached transfer, a direct firm-to-firm transfer of your investments. Now, while Betterment doesn't charge you to send money to your bank, they do charge a flat $75 fee per investing account for an outbound transfer to another company. Is it a deal breaker? No. But it is a cost you need to know about so you aren't surprised. Also, we must address the timeline. When you click withdraw on a standard investing account, the money does not pop into your checking account in 5 seconds. Betterment has to actually sell the underlying investments on the open stock market. That process takes time. The trades have to execute, and then the trades have to settle, which takes 1 to 2 business days. Then, the cash has to travel through the banking system to your linked bank account, which takes another 1 to 3 business days. Total time? You are looking at 4 to 5 business days before that cash is available to spend. If you are facing an immediate emergency on a Friday afternoon, you cannot rely on an investing account withdrawal to save you by Saturday morning. So, knowing all of this, what is your actionable takeaway? How do you protect yourself and secure your peace of mind? First, look at your Betterment dashboard today and identify exactly what kind of accounts you have. Separate your taxable accounts from your IRAs. Second, if you are already retired and need regular income, look into setting up a specific retirement income goal within Betterment. This allows you to set up automated, recurring monthly withdrawals that are optimized to be as tax efficient as possible, rather than panic withdrawing random amounts whenever a bill comes due. Third, always look at the tax impact preview tool inside the Betterment dashboard before you finalize any withdrawal. Let it show you the numbers. If the estimated tax hit looks too big, stop, step back, and reevaluate.